Hey guys, Omar here, broker and CEO of Alden Mortgage and Ome Realty. So this is going to be your mortgage rate update. On top of the mortgage rate update, we have to also look at, are we in a housing bubble? Are we about to have the biggest housing crash of our entire generation? Now, we've only had 5 of them. The panic of 1837, the stock market crisis of 1873, the Wall Street crash of 1929, the depression that followed the crash of 1929, and then the 2008 housing bubble that everybody knows about. We were in it. I've been a mortgage broker now for 20 years. And are we in a bubble? Where there's a common theme that we're going to go ahead and see on each and every single one of them. We're going to break each one of them down, and then we're going to go ahead and see, are we in a current housing bubble currently? But let's get on with the mortgage rate update. And if you are interested in any one of these mortgage products for up to 50% commission rebate, 0% listing on selling your current home, link in the description below. Let me help you save a lot of money. Let me try to beat your big bank. But let's get on with the mortgage rate update. As of 9/16/2022, we are going to be sitting at 30-year fixed, 5.58%. 15-year fixed will be 4.74%. 30-year high balance will be sitting at 5.71%. DSCR loan, which is a debt service cover ratio loan. This is where you take the income that is the producing income of the property and then put it towards the debt that you have acquiring, which is your principal, interest, tax, insurance, and other running costs. That'll be sitting at 8.50%. Bank statement loan, which is another non-qualified mortgage, non-agency loan. That'll be sitting at 8.12%. FHA 30-year fixed will be sitting at 4.98%. 7/6 adjustable rate mortgage will be sitting at 5.64%. USDA 30-year fixed will be sitting at 4.95%. VA 30-year fixed will be sitting at 4.98%. And then hard money fix and flip will be sitting at 9.75%. You see a distressed property, you think you could make a little bit of cash on it, you think you'll make a little bit of money on it. That loan program goes up to 85% loan to value. So you'll need to bring 15% to the table. And then there's going to be a piggyback loan on top of that, which will cover the 100% of the total amount that is going to be required to fix that property as a whole. Now, interest rates are going up. Just as of yesterday, let's say the 30-year fix was sitting at yesterday was sitting at 5.49%. Today it's 5.58%. Everything has gone up. 15-year fix has dropped. But as a whole, we're actually anticipating on the 20th, the Fed fund rate is going to come out. Now, the fund rate, just for some of you who don't know, the Fed fund rate is the amount that banks charge each other in order to buy and sell debt and then sell it to the secondary market. Now, the secondary market, you're going to go ahead and buy and sell and do all that other good stuff. The secondary market, that is the biggest thing that we're going to go ahead and talk about. Now, the panic of 1837, that was caused mainly between cotton, land, gold and silver depreciating in value, and the market at that time was very unstable. So that was like one of those things where we were just like, oh my god, this sucks, everything is going to shit. Everybody was trying to put money in, because it's almost like a get rich quick kind of thing, right? I want to go ahead and put money in the market. I want to see how much money I can make. You've all seen the videos, Margin Call, you've seen The Boiler Room, all these other movies that went ahead and kind of depict what has happened. But then you have the 1873 market crisis on May 19th, which was correlated with the Austria Stock Exchange. Now, the reason why the Austria Stock Exchange is so important is because the same reason why the Shanghai stock market is so important, the same reason why the NASDAQ is so important, the New York or the NYSE, the New York Stock Exchange. These are big platforms where people are able to go out and buy and sell different stocks depending on the company's performance. Now, at that time, people were just dumping money into, people had lost their damn minds, okay? People were dumping money into a market and they were trying to, once again, it's like a quick, get rich quick kind of thing, right? They were dumping money into the market and they were trying to say, you know what, we could go out and make money. But then what happened subsequently is that the unemployment rate started shooting up, low wages started coming into play, agriculture started taking a big hit, and then large banks were dumping a bunch of money into these loans that became completely deemed worthless, which then followed the 1930 to the 1940s, the Great Depression. Then we have the housing bubble of 2008. In 2008, of course, once again, we get to the stock market. The stock market, people were buying and selling bad loans. What they were doing is they were taking a bunch of these bad mortgages, right? They were putting in between good mortgages, and then they were putting it in these big blocks, and then they were selling it into the secondary market. Now, do you see a theme that's going on right now? Do you see what's happening? Secondly, is going to be currently, as of right now, we have a few things that are going on. We have the stock market who's going completely stupid right now. Everybody is buying, selling. There's sell-offs, there's buying, there's sell-offs, there's buying, and then there's like, everybody is going completely nuts. There's Tesla stock market splits are happening because they want to keep people engaged and keep dumping money into it. Now, if the stock market does take a hit, that will directly correlate with what's happening into the real estate market as a whole. Because if the stock market takes a hit, that means that companies are not worth the value that means that the stock market versus the companies are not worth as much as the people think that they're actually worth, because people are pulling their money back. Because whenever you put money into the stock market, what you're doing essentially is you're investing into companies to go ahead and grow. If you take your money out, that means that they don't have the money to go ahead and keep growing. Now in 1929, as a result, home prices, they dropped 67%, which then subsequently they just went to the Great Depression. The Great Depression went ahead and hit us at a point where inflation rose from 2% over to 6%. Now currently we're sitting at 8.3, 8.4% inflation, and we're trying to go ahead and counter that. That's why the Fed fund rate is, they're trying to counter this hyperinflation. Now that we're coming back into that, the rate of joblessness came in 1837, which the Panic of 1837 came in. That came up to 25%. Kind of hindered itself and kind of like, started stabilizing during the gold rush time of 1849. And then we go into the 2008 crash. By the end of 2006, the Federal Reserve had decreased interest rates from 6.25, where it was at, down to 1%. Lending practices were like completely, like they were letting us sell things that we shouldn't have been selling. Now that I look back at it, in my mind, I'm like, why were we actually spending money or able to do loans that we were actually able to do? Like we had this ongoing thing where we had funny loans, right? We would go ahead and call them like paper saver loans or one-liners. And those mean, essentially what it means is that the one-liners, all we need to do is just put an income. We just need to put stated income. That's just stated income. Like that just means that, I make this much money, and then we go ahead and do that. Now, we didn't think that home prices were going to decrease that much, because even though it was a stated income, you still had to put 20% down. Or if you were self-employed, we could do as low as 5% down. Now, those things were kind of still happening. Now, there was a looser approach when it came to banks and lenders. They didn't care too much. They didn't give a damn. They were just like, whatever. If somebody's going to buy it, it's okay. We could go ahead and put it into this other tranche, and then we could go ahead and sell it in the secondary market. Now, home prices, home ownership still has not recovered all the way. Now I'm going to show you right now, in 2006, 2007, home ownership in 2006, 2004-ish, home ownership peaked. Then it started dwindling down in 2008, and then 2008 it went ahead and just dropped completely down, and we're still not up at the home ownership level as we were before. Now in the Chinese, in the Shanghai market, they're in a little bit of they're messed up to begin with as a whole, because what's happening in the Shanghai market is people are boycotting mortgages. They're boycotting mortgages, and I saw something this morning which seems a little bit weird, which I'm going to go ahead and show you right now. Go ahead and take a look at this. High-rise building, okay? The high-rise building that was set on fire. Why is it set on fire? Is because people are not purchasing the loans. They are not paying the mortgages that they went ahead and said that they were going to go ahead and pay, because they're completely boycotting. So does it seem a little bit weird that all of a sudden this high-rise building just went up in flames? I don't know. Seems a little bit weird. Now, to get to the present, Now, majority of people already know in 2019, 2020, 2021, people were bored. They didn't have anything to do at home. So then they started buying GameStop. They started buying Tesla shares. They started buying cryptocurrencies. The volatility inside of the market went completely stupid and bananas. They just lost their damn mind. That's the common theme. The common theme is that the stock market is a driving force between all of this. They're the ones that are going to go ahead and either keep us afloat, or they're going to go ahead and cripple us. Now the market, the government will probably do one of two things. They're either going to let us crash and burn, or there's going to be another big bailout. It's going to be a massive, massive, massive bailout. Well, you let me know. What do you think is going to happen? So in essence, step by step, this is what's going to end up happening. Number one, the Fed fund rate is going to increase to a point that is going to be unattainable for investors to go ahead and dump their money into and then still see a profit to be turned. So the stock market is going to go ahead and take a hit. Then banks and lenders, they're going to go ahead and take a hit subsequently because they're going to go ahead and have a properties that are going to be depreciating at a level they've never seen. Number three, then that means that these loans that they went ahead and used to back these securities for real estate, those are going to go ahead and take a hit. Then banks are going to start to panic because majority of the homes that were purchased, let's say we purchased this home and it's, let's say for the sake of argument, $900,000. $900,000, if tomorrow I woke up and my house is now worth $700,000, that will go ahead and put me at a position where I am going to have to think, do I let this go? Do I short sale it? Do I foreclose on it? What do I do? That's exactly what happened in 2008. Property values dropped so much that that's what they went ahead and did. And then that's going to end up being what's called a housing bubble. It's going to take some time. It's not going to be an overnight thing. It's just going to keep going and keep going, and we're going to kind of see exactly where we're at after that. But that's going to be step by step what's going to happen. Number one, the stock market is going to take a crash. Number two, then the real estate crash is going to happen. Number three, number two, businesses will start floundering. Number three, real estate is going to go ahead and take a hit, because if you don't have the money to pay for your mortgage, then you don't have enough money to go ahead and keep that property. Sucks. Hopefully it doesn't happen. Hopefully we don't get into it, because the real estate housing bubbles that we have as a whole, they're far in between. We've only had 5 of them total. We still didn't recover from the 2008 crash. Even at the rate that we're in, at the home buying rate that we're in, where everything is just going nuts, we're still not at that 2008 level. Shit. Comment below. If you like the content, comment, like, subscribe, all that stuff. 50% commission rebate on purchasing your next real estate property. 0% listing on selling your current property. Or any mortgaging assistance. Let me beat your big bank. Till next video, guys. I really appreciate you watching. Peace.
I don't wanna waste the minute.
Want to see what 3.2
Gonna run the plans, swing it.